Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Market Minutes for September 7th, 2020. Please see our disclaimer for important information. So in the conversation this week, we're going to cover some ground related to the market. We're going to cover a little bit on labor as well as the economic backdrop here as we sit in the early days of September here. But obviously we need to cover the market because we had a little bit of action in the market last week. The S&P 500 was down 2.3% for the week. The NASDAQ was down 3.3%. Dow itself was down about 1.8%, and basically the NASDAQ and S&P both hit all-time highs on Wednesday, and the Dow was just about 1.5% below its all-time high, but the S&P dropped 3.5% on Thursday, and the NASDAQ was down almost 5%. Basically, in the final 2 days of the week, the U.S. stock market lost about $1.7 trillion of value. Now, having said all that, basically the market is still up about 13.1 trillion from the lows of March 23rd, which is a return of 55.7%. And even still year to date, we've added about $2.2 trillion in market value in the S&P 500. So despite the kind of this visceral reaction in the market for a number of reasons, there's still some silver lining out there with regard to the year to date. And interestingly enough, I mean, most of this was driven, I mean, we had some really, really big action on the part of large stocks. Like on Thursday, Apple lost 8%, and that was the largest loss of market capitalization on record. In fact, Apple just in aggregate terms lost $180 billion of market cap on Thursday. And interestingly enough, in the Wall Street Journal, there are only 30 stocks in the S&P 500 that have an entire market cap greater than 180 billion. So this is a extremely interesting development. So obviously volatility was rising. There were a lot of reasons why the market sold off. We have a whole lot of bullish attitude out there, and you look at basically they call the put call ratio. And if you are if you're buying calls, you're expecting to make money as the market goes up, and usually you tend to have a little bit more call buying than put buying, which you buy puts if you expect the market to drop. And so you typically are on balance optimistic about long-term growth, and that's why you typically would have more call contracts open than put call. But I mean, lately that ratio has been 15 to 1 calls to put. So it's a very interesting development that indicated an extreme bullish attitude. But other things that were cited in Barron's, Citigroup's panic euphoria model was 3 times higher than the level that would typically signify euphoria. So I mean, this is nosebleed euphoria basically. And also the Investors Intelligence Survey, the percent of bulls was like 40% higher than bears. And then obviously on tech, I mean, there's a whole lot of reasons why that we might have seen a sell-off in some of these names. But I mean, technology was trading at 27.5 forward earnings, which is an incredible level, and trading more than 30% above its 200-day moving average, which in itself is pretty impressive. And then we had a lot of insider sellings. U.S. executives sold about not quite $7 billion of stock in August, which is the biggest amount that we've seen in 5 years. And obviously we've got election fears, we've got virus rhetoric going on out there, and we're still kind of stuck in this quagmire politically of not having another relief or stimulus bill out there. And but anyway, so again, we have extremely low interest rates, even though the 10-year Treasury moved a little bit higher from about 62 basis points to 72 basis points, or 72/100ths of 1% on Friday with this sell-off. And And even with a reasonable jobs report that we had last week, it just kind of indicates that there's just kind of a ho-hum attitude with regard to the bond market. But low rates make stocks look a little bit cheap, and a second wave of virus makes potentially tech stocks look attractive amidst this rhetoric as we're seeing heading into the election. So, just a few other kind of conversations. We'll talk about the labor, and then we'll talk about the economy, just some observations, some of which are from Wall Street and Barron's. I mean, some of this is covered by Sandy Leeds in his weekly commentary. But interesting article, individual trading now accounts for a greater chunk of market activity than at really any point over the last 10 years relative to institutional type buyers. And individual investors for the 6 months of the year accounted for almost 20% of the shares traded on the U.S. stock market, and that was up from about 15% last year and almost 2x the level from 10 years ago. And amazingly, in some days, you have about 25% of the market volume that's accounted for by individuals. So, obviously, this is not your father's market anymore, where most of the activity was not dominated by individuals. You have a lot more influence by investors that you would kind of, in many respects, argue are not nearly as sophisticated as your institutional investors. But just a couple of other things. We had a total of 525 businesses file for Chapter 11 protection in August. Again, this is not liquidation. This is protection from creditors or reorganization. That number is down 18% from the 642 that filed in July, but it is up 17% from a year ago. And in the first 8 months of this year, again, encompassing the full impact of the pandemic, Chapter 11 filings were up 28% to 4,800. And the issue is that obviously smaller companies just don't have the same access to liquidity that larger ones do. But interestingly enough, if you look at the investment banking area, banking and trading revenues were an 8-year high for the first half of the year. We have an incredible almost 30% increase in highly rated corporate debt issuance and globally, and then 72% in the U.S. This year. And revenues from fixed income trading were up significantly year over year, over 50%. And then again, as we kind of look back over the last month, stocks had their best month since April in August, and all three indices were up for 5 consecutive months. And basically the S&P 500, again, kind of going to that statistic that we talked about at the beginning of the call, the S&P is up 35% in the last 5 months alone, and that's the largest 5-month consecutive gain since 1938. And the index itself was up 7% for the month, and that's the best August that we've seen in almost 30 years, really. And so strong market activity despite what happened on Thursday and Friday. Even though Friday was turbulent, the market kind of had a little bit of an updraft towards the end. But if we kind of get into expectations and get into kind of what's going on in the economy, I think expectations as we sit here, we know that output is still going to be below its level that it was at the end of last year. We know for the time being inflation remains low, but as we've talked about the last week, the Fed is clearly saying that it's going to let inflation run hot by keeping rates low, and so that the average over a long period of time is kind of that 2% that they want. But clearly we need more fiscal stimulus out there, and we know unemployment rate is probably going to be continuing to be in the high single digits there. And again, we'll talk about labor in just a second. But GDP in the second quarter was down 9% from the first quarter, and on an annualized basis, that's down 32% year over year. We'll get third quarter GDP announcement at the end of next month, and we're probably going to have a good number, and that probably annualize to something close to a 25 to 30% annual gain. But that still leaves us below year over year, and it's going to take us a little while to get there. And as we kind of look at the business backdrop, we know that we know that businesses are struggling. We know small businesses are struggling. In fact, the number of small businesses that are open is down 19% from January, which indicates in and of itself that there's less rehiring of people. Small businesses, have been disproportionately impacted by COVID-19, and as I mentioned, hourly staff is down 20%, businesses open down 20%. Half of regional contacts in the business world say it will take at least a year for the average firm's activity to return to pre-pandemic levels. And this comes from the Cleveland Federal Reserve. Survey shows that consumers are now more willing to perhaps engage in certain activities than they were at the start of the pandemic, which is a good sign. But at the same time, they also believe that the pandemic issues will linger much longer than originally thought. In fact, in March it was like 80% thought it might be a year or less, and now at the middle of last month, over half think that it's going to be up to 2 years. So that's pretty profound when you look at expectations. You look at hiring intentions on the part of businesses that don't have this confidence, that don't have this visibility. You think about capital spending intentions and people kind of withholding their appetite for spending. And so all of this impacts the economy a little bit until we get a little bit more certainty with regard to the virus, a little bit more certainty with regard to policy, and a little bit more certainty with regard to access to capital and things like that. These numbers might remain somewhat murky. In fact, businesses I think are having to kind of retool and rethink because of this uncertainty. Again, we know that small business activity is down, but essentially, a lot of firms are saying that they might have to make really tectonic changes in plans, specifically related to hiring and capital spending, and we know that there's a risk of permanent job loss. Interestingly enough, the Beige Book, which the latest one that comes out of the Fed, which is essentially a survey of regional, it's a compilation of regional economic surveys for the various Fed districts. But interesting that they published that there could be a labor shortage despite this higher unemployment that we have, and a lot of this comes from lack of child care and concern over schools and parents having to be at home and not in the workforce. And even if they're at home and able to work remote, then they're distracted because of kids out there. And we've talked about this in prior calls about the issues that are incumbent with kids not being at school, which is almost kind of in some respects an institutionalized form of daycare. So this clearly is something that's filtering back up through these Fed surveys. So we'll have to continue to monitor that. But just talking about our debt load, we know that we have very high federal debt loads that we're probably, at least the amount that's held by the public will at a minimum equal, if not exceed, the level of the total economy in the fiscal year, which begins at the beginning of next month. And the current fiscal year deficit could be 3.3. If we get more stimulus, that could be as high as, could be even closer to 4 trillion. We just don't know yet, but I mean, it was already going to be like over $1 trillion prior to the pandemic, which accounts for more or less 5% of GDP, even though interest rates are low, and so the debt service on that increased debt is fairly low. but there's an increasing feeling out there, what we're going to call, or what we call modern monetary theory, or MMT, just this theory that you can just print away, that basically, it doesn't really matter. You can borrow in your own currency because you can't default, because you just simply print more money to cover the debts, but you're not adding to investment. You're just basically replacing lost income in that case. And so, you will have to pay the piper at some point, and part of the price that you pay for just simply increasing your debt load to fund your profligate spending is that you kind of get a little bit more of a more of a muted economic growth rate over time, and you run the risk of stagflation and things like that. So this is something, as we watch this debt load go up, even with low interest rates and the burdens on the government from an interest cost standpoint not being tremendously high, that the implications are fairly vast for needing to control our spending down the road once we get past the pandemic, and needing to inspire more job growth, business creation, and things like that, and which is clearly not happening as much right now. So something that we're definitely going to have to follow over time. And I think what this also does is, if you have this notion that we're going to have higher debt levels and slower overall growth, then that would naturally tend to want to find its way into the stock market in terms of less robust expected growth rates going forward. So we're going to have to think about that going forward. But if we look at labor, kind of transitioning there, as we kind of really jump into this recovery phase, if you will, having been through the shutdown phase and this reopening phase, which we're still kind of transmitting through. We know that last month the job number was okay. We added 1.4 million jobs. We know that almost 250,000 of those were for the Census Bureau, and so we've added 7.5 million jobs since May, but we lost 22 million in the pandemic. So I mean, we still have 11.5 million fewer people that are employed today than were employed in February. Even though we had the unemployment rate drop down to 8.4%, and we had a slight increase in the participation rate. Again, those on the surface are really good things, but again, the August payroll number was basically enjoyed the comments this week, and hope you have enjoyed a wonderful Labor Day long weekend. I believe that we all do need it, and hope you have a wonderful week, and be safe, and feel free to reach out to us, and we'd love to hear your feedback. So that will do it for us in this week's edition of Market Minutes. Hope you have a safe and wonderful week. Feel free to reach out to us at the information provided. We'd love to hear from you. Be safe, have a great week, and we'll talk to you again soon.